All right, let's go ahead and get started. Wednesday, May 1st, 2 p.m. Recording on. Last day of lecture before group projects on Monday. So here is the sign-in sheet. Please make sure you sign this before you leave today. Hopefully everybody took advantage of that extra credit opportunity. By the way, I've gotten some questions about the TA opportunity. That's the link right there if you need to apply for the TA for fall next year. All right, Monday is the group presentations, but just end of semester deadlines one more time. Tomorrow, 5 p.m., two deadlines. One, if you're going to do the assignment replacement, and that's where you put it in, that's the last opportunity to do it. Tomorrow at 5, right? If you don't do it by then, actually end of day tomorrow. You can't do it next week. So don't call me next week and say, I didn't do it, I need to do it. So if you got to do it, tomorrow. Also, tomorrow is the end of the Bloomberg Trading Challenge second half. Here is where we stand as of today, with 1 day to go. All right. Good news, everybody's done at least 10 longs. Good news, everybody has less than $300,000 in cash, so don't liquidate today, don't sell today. Continue as if you're doing another day. I think first place is pretty set. All right. So, and there's, matter of fact, it's interesting, out of the 24 teams, they're the only team with a positive return. I've never seen a victory, which I had to call this a victory because it's a pretty impressive return, that great ever in this class. So you have the highest portfolio return relative to second place in the history of this class. So congratulations. Where's the K-Wang team? All right, give yourselves a round of applause. Normally, I don't like to show what you do, but no one's going to copy you in a day. So what was the secret to your success?
We shorted Donald Trump stock and Reddit stock.
Oh, you really made a lot of money off of Trump? Good job. All right, so you also did what?
We shorted Reddit as well.
Reddit?
We invested in Alibaba and BMGT.
All right, so how big a return did you make on shorting those two stocks? You remember?
I'm not sure because we shorted Trump stock a few times.
Okay. So you shorted Trump stock, which to be honest with you, you benefited in the trading competition because it's actually hard to short in the real world because so many people want to short it. But regardless, so you shorted the two. That made you a lot of money. That's pretty clear. And then you went long on who?
Alibaba, JD, and
Yeah, I don't like to do this, but I want to click on your portfolio. So Alibaba, JD, and who? Looks like Google's your other big winner.
I guess Google.
Yeah, but Alibaba, JD. So obviously the two Chinese e-commerce firms, which have been performing relatively poorly for a while, but recently had a spike up. And you guys actually did pretty well in their spike up. What caused you to think that they were going to do better in the short term? Just out of curiosity.
I was honestly betting more on kind of a longer term recovery, but I just figured like, if it starts, it's better to get on.
Yeah.
I figured it would kick in at some point like, during the semester.
Well, like I said, you timed it really, really well because I think JD, you hit them pretty much at their bottom when you bought them. And they're up like 10-15% since you bought them, obviously. And same thing with Bobos, have been bouncing around, but a little bit of an uptick. So, even though they're long-term bets, it worked out for the short term. But regardless, congratulations for doing so well. So for the rest of you, it's pretty close. Like, there's a couple of things that could change in here, particularly last place. So again, the grade distribution, if it were to end today, well, they're getting 5, doesn't matter. They're going to get 5, 4, 4, 3, 2, 1. That's basically the way the distribution would be as of today. Okay. So that's tomorrow, end of day. So again, don't liquidate. Sometime after 4 to 5 tomorrow, I'll take some final screenshots, post them, and then the grades will be in. Questions about the trading competition? Yes.
Do the last two companies get one?
No, 2 and 1. Last place gets 1, second to last place gets 2. So I'm saying you guys are fighting out for that point. Yes.
Have the grades been put in yet for the first part of the
So somebody asked me about that. I don't think, sometimes they're hidden, and if I don't click a button, you can't see them. So I have to click the unhide button so you can see them. But they're there. And matter of fact, all your grades, context, have to be in essentially by Friday. Because the TAs, so back to the end of the semester, they have to take the assignment replacement, that's why it's due tomorrow, replace the assignment, and then apply the final exam opt-out criteria. So they can tell you on Monday whether you're opting out of the final exam. Everything's got to be in there this weekend. So it will be. Yes, sir.
Did you say it goes 5-4-4 or 5-5-4?
It's 5-4-4. 5-4-4-3-2-1 will be the grade distribution. Other questions? Yeah.
Do you know if the Homework 13 will be graded before the assignment replacements due?
I don't know if it'll be graded before end of day tomorrow, but it will be graded this weekend, obviously, because it's got to be done by Monday. So I'm meeting with the TAs either tomorrow night or early Friday morning, but I won't know until then. But like I said, they're working their best, and obviously, like you, have things at the end of the semester. So if my recommendation to you is, there's a reason why people buy insurance policies. So if you think you need it, pay for the policy. If you don't need it, it didn't cost you much. Like, write the 500 words just in case, even if you don't think you need it, just because you won't be able to give it the opportunity to do it later. If you think you're going to need it, okay? You're in that situation. Other questions? So again, end of semester, again, logistics one last time. I know we've been talking about these, but Monday, you'll do your final presentations, which we'll talk about later in this class on multiples, right? And then sometime Monday, near the end of the day, going to the evening probably, we'll make an announcement to tell you whether or not you should check for the final exam opt-outs. So if you opt out, then we will put in, you don't put in, we put in, under final exam opt-out points, 10 points, okay? And so if you see 10 points, you don't take the final exam. You see a 0, you take the final exam on Wednesday, 1 week from today. Again, final exam, 10 multiple choice questions. You take it on Helms. You take it during the section you're registered for. So for you, it'll be 2 to 3:30 if you have to take the final exam on Wednesday, all right, electronically. It'll be 10 multiple choice questions, open book, open notes, but it's an exam, subject to the honor code. All right, so any questions about anything related to end of semester? As I said, we have 2 last meeting times today and Monday. Monday, we'll do 16 presentations. After you're doing that, you're going to be pretty tired, ready to go. So what I actually want to do today, before I talk about Monday one more time, is just kind of a review. Kind of reviewing some of the things that we've done this semester, just to kind of remind us. Right? So when we got started, seems a lot longer ago at the beginning of the semester. But one of the things we talked about was, in the book, what they called the 4 cornerstones, but I said these would be 4 kind of important principles. We'll talk about the semester, which go beyond, all right? And that first one was the concept of spread, ROIC versus cost of capital. And I think you've seen it working pretty well in the real world as we've gone through a lot of these exercises. I mean, they play out a lot of things, including what you're going to be doing with your group projects on Monday. I was telling the previous classes that one of my new companies I'm going to probably be working with is ANZ Bank of Australia. And I was on a call with them yesterday with their chief strategy officer and about value creation. And one of the things that they want us to talk about and explain to them is what's going on with the Australian bank market. Okay, and basically in banking, we don't really do banking in this class because banking is just a little bit more complicated. So the principles apply, but the real problem goes back to Modigliani Miller, debt, right? For most companies, manufacturing service firms, debt is a 3, okay? But for banks, it's tricky because debt can be a 3 or a 1, right? And what I mean by that is when you borrow money from a bank, they lend you at an interest rate, let's say 5%, and they borrow money to lend it to you at 3%, and they make money on the spread. It's called net interest margin, right? They also borrow money to fund the bank long term. So the problem with banks is the debt. Like, is it operating, like they're actually making loans off of it, or is it financing, which is long-term capital, which is a requirement? And it's kind of tricky to segregate out the two, especially if you're an outsider. So basically, we don't, and we just use what's called return on equity, right? Just ignore the debt, right? But the exact same formulas, the exact principles apply. It's just we kind of take out the debt because it's just hard to look at the debt. I'm not saying we don't do debt. It's just, matter of fact, a lot of banks I work with will actually do an ROIC. But it's funny, when they show you the ROIC, they'll show you like 50 different assumptions they had to make to calculate an ROIC. And if you're an outsider, like you're not going to replicate that. So we don't. But here's the point. Spread still applies, anything you do. And so in banking, the other metric they look at is called price to book, right? And it's basically the market value of the company divided by the book value of equity. And so if your price to book is 1, that means you have a 0 NPV, 0 spread, and you're not creating any value. Whereas if you have a high price to book, that means you have a positive spread, you're creating value. And so basically in the Australian banking market, 10 years ago, the price to book multiples used to be 2 to 3. And what you need about Australia is pretty simple. There's 4 banks in Australia, which are like 90% of the market. And the government of Australia has done a really good job protecting the market. So it's really hard to break into Australia. So they are like an oligopoly. They just kind of chop up the market, and it's really good for the companies. It's really bad for consumers because you don't have a lot of choice. They all charge the same thing, and they made a lot of money. And so their return on equities, all of them were like 20%. Okay, so the price to book multiples were like 2 or 3. Well, today the price to book multiples have fallen to 1. Okay, and one of the questions that I'm going to try and help them understand is why. Like, what happened to all the stock prices? And I'll just give you a data point. ROEs today are 10, and cost of equities are 10. They don't have any spread anymore. So in the last 10 years, the spread went from very high to break even. Well, when you have a break even spread, we know from key value drivers, you're not going to create any value. So what I'm saying is like the principles that we talk about in this class very much apply to the real world and can help you explain a lot of different things. Right? And we will, and we do. So that's one of the reasons I want you to remember that. Another thing we talked about was the importance of cash flow. And the third one was actually the big cornerstone, which is expectations. Right? Expectations play a critical role in almost everything we evaluated. Right? We got to talk about the future. Right? Because as I say, you can't drive a car, look in the rearview mirror, and price is based on expectations. Right? So it's not what the company did, it's what the company's expected to do. And we deal with that, we deal with risk. I mean, that applies to anything, by the way. So, last 2 nights, I went to 2 Orioles games. Yankees, Orioles. All right, the Orioles won them both. Right? If you're an Orioles fan, it's an exciting time to see the Orioles. Right? Fighting out for first place. But you know what? There's another game tonight. Another game tomorrow afternoon. Who's going to win those games? Okay? That's the difference between accounting and finance. Like, we have to figure out the future. And when you deal with the future, we can't say with 100% certainty that the Orioles are going to win the 3rd game in a row. Like, that's not a given. And that's just like valuing a company. Like, it's all the cash you're going to generate in the future that leads to your price. Well, what is that cash going to be? It's constantly evolving. So we've been talking about Tesla a lot recently because Tesla's been so volatile because the expectations are volatile. And as the worm turns, what was the latest news last night from Elon Musk? I mean, I think this week he really has stopped taking his lithium. But basically, what did he do yesterday that affected the stock price today? The latest change at Tesla, which is a signal not only for Tesla, but potentially the market. Anybody see the news today on Tesla? Affected their stock price. Yeah.
Is it like cutting back on their superchargers?
Yeah. He took 500 people that run his supercharger network to charge the Teslas, and he fired the whole division. They're all gone. Just chopping off all their heads. And ironically, this morning said, we're going to offer some of them their jobs back after firing them in a very Glenn Ross way. But the point is, the market looked at that kind of negatively on 2 levels. Here's Tesla. Let's see if that changed in the last couple hours. Stock price today back down $2. Right? Because number one, 6 months ago, Tesla, there's a competing standard for the plugs that go into your electric vehicles, and Tesla basically got all the automobile makers to agree on their standard by agreeing to license access to their superchargers for several $1 billion. So they were going to actually make a lot of money on these superchargers, not just from charging their own vehicles, but charging all the others, Ford, IBM, or BMW, etc. And also the Biden administration was going to give them money out of the Infrastructure Act to support rolling out the superchargers. So the market looked at this as a big win for Tesla. And yesterday, he shut down that division. Just fired them all. So the market's like, okay, what does that say about the future here and your ability to generate cash? I'm sure there's a reason for that, but it just goes back to that uncertainty and volatility. It just adds more uncertainty to the cash flows of what's going on in the business. But it also leads to our next point about EIC and says, is that just another indicator that people are not buying as many cars? And that market is just not growing as fast as we thought even 6 months ago. And we're just getting these data points. And as the future becomes more clear, I think you'll get a better view of what the stock price is really worth. But this is the volatility. It's the uncertainty that's being played in the marketplace. But we understand why, because it goes back to expectations. And by the way, your trading challenge, the reason why I have you do this Bloomberg Trading Challenge is all about expectations, right? I want you to pay attention to what's going on in the real world. That's why we don't do Harvard Business School cases in this class. That's why I don't pick the elegant solution every time. I want you to see how this applies academically in the real world. And you know what? Sometimes it's messy, sometimes it's not, but it should still work out. And we should have an appreciation of how it's going to work out. And that's what we do. And again, a lot of it is that future. And then the fourth cornerstone is competitive advantage. Like if you don't have a competitive advantage, you're not going to outperform. And so we look for companies to say, do you have an advantage? And more importantly, for how long? Right? And so the same thing, is it an attractive market? For how long? Nothing lasts forever. Just remember that, even beyond this class. And so I would imagine that in the Bloomberg Trading Challenge, none of you took the approach and said, let's just go find an average company that will perform average over time. Like, I don't think that's what you were looking for to try and win the competition. Like, just like investors, we want to find above average performance. Well, there's got to be a reason that you're above average. You got to be good at what you do. Or you're really lucky. That's not going to last for long. So basically, that was the fourth cornerstone. And so we're always looking for the above average company and a reason for that. But the other part is the how long. Matter of fact, this week, I think Apple today reports its earnings. Okay? And what I'm going to guess, sorry, I'm being rude, other people are talking. What am I going to guess when Apple reports its earnings is you're probably going to see a decline in iPhone sales. Again, second time, right? And again, I think the issue is it's not a question of Apple. It's just like any other company. I think the iPhone's getting mature. And as much as I'm an iSheep, we'll probably buy the next one for $1,400. They're not all that different. I mean, they're just barely incremental changes phone over phone right now. And the competition's actually getting better and better. So, and people are keeping their phones for longer and longer. So that's just natural progression of markets. And Apple's trying to find the next big thing, but they're not really a growth company anymore. Right? And they're just kind of monopolizing their business, but they're not finding that growth vector, and their phones aren't growing. They're starting to become much more mature. We should expect that. And that's the point. It's not an indictment against Apple. It's just this is the natural evolution that businesses go through. I think Apple is going to that. Now they're just a mature company, and their core business is starting to slow. So the next question is, what's next? And we know that the what's it called? The Vision Pro is not the superstar performer of what's next, at least not yet. So you know what Tim Cook is going to be talk about today? I'll predict it right now. It's going to be the AI call. Right? Nobody knows what AI is yet, but we know it's the next big thing. Apple's going to be talking about it, just like Elon Musk. We're going to be the AI company, right? And AI is going to generate all this revenue. There won't be any specifics, but that's going to be what they're going to push. And that's the whole point. Like, it's a big market. It's a very attractive market. Everybody wants into that market. We don't know how big it's going to be. We just know it's going to be big, and we know who's going to win. Everybody wants to participate. We'll start to see it over time. But that's the point. Apple's going to want to be there. They're going to start talking about that. It's going to talk more about that, my guess, than the iPhone, because they don't want to talk about the iPhone. They're going to want to talk about AI. Anyways, that's just a guess. But so future and competitive advantage. We also spent a lot of time this semester from day one talking about key value drivers. This was the click down math. This is really very important to everything that we have done in just about every assignment. And understanding the math and understanding the value drivers is really important to understand what happens to any company, any decision, how we make decisions, how we make investments, how we evaluate companies. And it's these 5 things, right? Mathematically, which we know over time is margin, productivity, risk, growth, and that sustainability of advantage. That's value. And ultimately, we broke it down to growth and spread. That's your analysis on Monday for your group cases on multiples. They're just growth and spread. That was your valuations in the last group project. The only difference in your last project, we did valuation and DCF valuation and multiples, is we went 5 years before we did the key value drivers. Where in multiples, you just do key value drivers from day one, right? So it's kind of similar analysis. It's just we're starting today forever as opposed to starting in year 6 forever. But the point is, we know values based on these things, and we can look at any headline and start to understand what that means. Matter of fact, understanding the key value drivers is understanding why, except one team, why 23 teams lost money in the Bloomberg Trading Challenge in this half of the semester. It's all key value drivers. And why in the first half of the semester, almost every team made a profit in the Bloomberg Trading Challenge. Okay? And it goes down to what I had on video at the beginning of the class. Federal Reserve and interest rates. Okay? Because at the beginning of the semester, if you can remember, long ago, the talk was that interest rates were going to start to come down. The Fed was going to reduce rates because inflation was coming down towards 2%. We were above progress. There were going to be some rate cuts, and the rate cuts would reduce interest rates. Well, here's the thing. If interest rates go down, WACs go down. If WACs go down, value goes up. Okay? That was the first 6 weeks. Everybody priced in a lower WAC, and everybody assumed that that lower WAC was going to lead to higher prices. And so you pick just about any company, and it was going to do better with the lower discount rates. Well, what's happened in the last 6 weeks is the opposite. Inflation has been stubborn for the last few months and slightly higher than expected in the 3 range, not the 2 range. And the Fed has been pretty clear. Until they believe that inflation's at 2, they're not going to lower interest rates. Well, that's what they've said now for 4 consecutive months. That was the announcement they made, was 40 minutes ago. Okay, when they came out at 2 o'clock today from their meeting, the press release they gave was inflation's not at target. We're not adjusting interest rates until inflation gets that target. Well, here's the point. Relatively, the market expected rates to go lower. They realize they're not going lower. They're now higher. Cost of capitals are now higher because of that. Higher WAC, lower prices. That's why 23 out of 24 teams could not beat the market, because if you have a higher hurdle rate, your values go down. And we know that happens in key value drivers, right? And so that's the point. Like, this plays in just about everything that we do, just about every assignment and every decision. And so this is just something that I hope sticks with you well beyond this class, right? Because this will help you understand the real world much better and apply this in decision making. Once we did the intro, and the other piece is 50% of your performance is your industry, we then went right into EIC, okay? And the whole point is, if half your performance is that industry or market, then the economy in the industry is really important to understand. The first section is doing their industry on airlines, right? And the data point is simple. 20 to 25% of an airline's cost is fuel. When fuel costs are high, none of the airlines are making money. When fuel costs are low, the airlines make a lot of money. What's been happening right now is oil is above, I think, 85 a barrel, and it used to be 60 something a barrel. Well, it's harder for the airlines to make money if your fuel costs go up by 33%, right? So they're all starting to struggle, reporting less profits and less growth, and that's just economic, right? So 2 things. We're going to be looking at macro conditions, inflation, interest rates, levels of growth, attractiveness of markets. That plays out the companies. And again, you can see in the Bloomberg trading competition, when the markets got tougher, as rates went higher, it's really hard for stock prices to go up, right? Unless you just blow away cash flow. You need a whole lot more cash flow at a higher discount rate to get a higher stock price. A couple of companies beat that, NVIDIA being one, right? But generally, it's been tougher, and that's the market we're in. And then number 2, the industry. There's a reason why we do 5 forces, right? When industries are attractive, companies, it's an easier path to make money, and they tend to make more money. When industries are unattractive, you don't make money, right? And then the final one is competitive advantage, right? When you have a competitive advantage, it's easy to outperform. When you don't have a competitive advantage, it's hard to outperform. So do you have one? And for how long? You know, we're doing the tech industry. One of the reasons why most of your tech companies have high multiples compared to all the other industries is because they do have competitive advantage, okay? They do have, essentially, Meta, Facebook, it's a friggin' monopoly. They have 2 billion users every day, right? It's not easy to get people to switch all their users to another network at this point, right? And that competitive advantage helps them make high rates of return. Apple makes a lot of money because of its app store. It's the walled garden, right? You got to pay them 30% to participate if you want to be on the phone. A lot of people want to be on the phone, right? Matter of fact, it was funny because this morning I posted on my LinkedIn, Bloomberg Business Week had a really interesting article about CarPlay and how CarPlay has become so dominant that 70% of people will not buy a car today if it doesn't have CarPlay or Android Auto installed. And General Motors a couple years ago saw this dominance and said, we're opting out. We're not going to allow CarPlay on our cars, and we're going to have this stupidly named, I think they called it like Ubiquity or something, version of CarPlay that they were going to self-deploy, right? And their software is so god-awful that it's actually hurting sales of the car. Matter of fact, they were talking about the car of the year by Car and Driver was the Bronco, but the Bronco doesn't have CarPlay. So the user reviews are terrible and people are stopped buying it because the other thing is their software is so bad that it literally made a couple of the cars non-functional because when the software shut down, the car shut down. And there was a guy they talked about in the article that was waiting for a month for them to figure out how to fix the software and he couldn't actually start the car. I mean, just you hear these awful stories, and then the whole article is like, does GM know what they're doing, trying to develop software? Because last time they did this, they bet on OnStar, and I know that was a super success, right? And so now they're kind of betting against Apple, but that goes back to the point. Apple's so dominant in there, they're probably going to go crawling back to Apple because they don't know how to build software themselves. But regardless, that goes to Apple's competitive advantage. Now here's the thing, like Microsoft before them, the government's having a say in this. Antitrust is coming in. Just like antitrust came in for Microsoft, just like antitrust came in for IBM, antitrust is coming in for Apple. And they're saying that, look, you can't have this walled garden, right? You got to make it more open. You can't just make 30% prices and force people to pay that to use your app store, right? That's anti-competitive because you're so dominant. And in a way, part of Apple's competitive advantage coming down is not just Apple, it's the EU and the US and probably China, which are going to force them to be more open. That's good for the customers, but it's going to be less profitable for Apple, right? And so just things like that, we have to pay attention to. When I looked at the pharmaceutical industry last class, pharmaceutical industry averages 20% ROIC. It's huge spreads. That's the average. And you can basically narrow that entirely down to one word. What is the one thing that explains the outperformance of pharma? Yeah, patents. When you got drugs under patent, you make a ton of money. When you don't have drugs under patent, you don't make anything. So how many drugs under patent do you have and for how long? That's pharmaceutical valuation, right? If you're, just as an example, if you're one of the weight loss drugs, then the question is, if you're Lilly and they have a drug now called Mounjaro and Zepbound, which is going to be $40 billion a year at a 95% margin, like that's going to be just nirvana for them for the next few years. But that drug, like everything else, is eventually going to go off patent. And when it does, they're not going to make nearly as much. That's Merck and a drug called Keytruda, $30 billion a year on a cancer drug. Again, 90% plus margins, huge profitability. Come 2028, patents expire, and then you're not going to make 30%. You're going to get $10 billion at a 30% margin instead of $30 billion at a 90% margin. Well, the values are going to come way down. Okay, so they got to find out what's next. So again, understanding company, what's going on in the industry, really critical to valuation, not just today, but tomorrow. That's why we do these EIFC frameworks. And it's something you should always pay attention to, even when you're doing your other jobs. Even if you're not doing a finance job, it's important to understand what's going on around you. Second part of the class is we did look backwards. All right, we introduced Modigliani Miller, and we put financial statements, which I know you loved, into this framework. Now, this is something that you're going to see less in the real world. This is a very niche McKinsey approach, and most other people don't do it. Okay, they're not taught in business schools, it's not taught in the real world, but I hope you saw the value of doing it. It doesn't mean everybody else is wrong. It just gave you a little bit of additional insight into what's going on. And I hope you remember that insight as you go forward, as you think about businesses. Like, you're not going to see TIIs or TFIs in the real world. But when we did our ROIC trees, I hope you understand the drivers of return. And when we did CFIs, I hope you understand the drivers of cash flow. because those are going to be the real drivers of value, and we should be able to connect more dots to understand why things are happening. Right? And that's really, really important. But it's also important to understand that the past doesn't predict the future. Matter of fact, that's where Wall Street gets in trouble once a decade. There's a crisis on Wall Street once every 10 years, right? And the reason why is because people believe that the past will predict the future. So they build models in the past to predict what should happen in the future for their risk management. So for example, in the financial crisis of 2008, 2009, real estate, the assumption they made, every Wall Street firm, was that housing prices would never go down. Because for 10 years, they hadn't gone down. So based on the last 10 years of data between 1998 and 2007, because housing prices never went down during that 10 period, they built risk models that said they will never go down. And in 2009, when housing prices went down, they're like, we don't know what to do. Prices went down. This should never have happened. And the other thing they did is they built their models on correlation. And they looked at historical correlations. Because you know for diversification that you diversify by buying uncorrelated assets. You don't want prices to all go down at the same time. And in 2009, all these historically uncorrelated assets had correlations of 0.9. And they said, this can't happen, but that's exactly what happened. And it took down the banking industry, right? Because all of the collateralized loans and everything was based on models, on historical data, and when the data changed and what happened in the past didn't happen in the future, it killed Wall Street. And once a decade, that was the last banking crisis we had with interest rates. Like, all these banks built their risk models on low interest rates. We had low interest rates for a long time. Interest rates rose. Their models didn't predict interest rates rising. Like, you kind of look back at this in hindsight, and you're like, how could they not have thought this? These are pretty serious people. But that's what happened, and that's why all the banking models blew up, because nobody predicted that we would have higher interest rates. And then we did, and a bunch of banks got screwed. And then again, another bailout. So these crises come. So I say this because whatever you do, be careful when you look backwards. Right? Now we look backwards for track records. But you hope, this is that expectation cornerstone, constantly at work. That's why we got to think about the future. We price based on the future. We invest based on the future. We make decisions based on the future. And that applies well beyond finance. So that future orientation is important. Remember, that future has risk. And the past doesn't always guarantee that future. Okay? It does until it doesn't. And I just think, remember that as you go through your careers, and I think that will help you. If nothing else, remind you of the biases that we have. The third section of the class was valuation. We did DCFs. Right? Not going to bring up the models, but I hope you saw, based on the valuations that you did, that we built models that were pretty realistic. Like, we could value companies and we could explain their values on a cash flow basis. Like, these were very real world models. You could use them in the real world. People have. I was joking with the last couple classes that I post videos, as you know, on YouTube for all of the classes that we do. And I actually have people from different parts of the world who are actually taking the class along with you that I had no idea. Like, I have a guy from Indonesia. I have somebody, I think, from Saudi Arabia and some other country. And they like email me. They're like, I see your class on YouTube. I'm going along with your students. Can you please send me the Bloomberg models so I can actually do the same assignments that they're doing? And I actually don't, right? Because I know what the follow-up's going to be. Oh yeah, I need the Bloomberg data and all this other stuff, and I'm not going to do the whole work for them. Like, they're not taking the class. You guys pay to be here. I appreciate that they take it online, but I'm not going to let them take it for free online in a foreign country, despite the fact that it's kind of cool. But that's the whole point. Like, these are real world models. I've had students that use this in Sembit funds. Some of you have used this in case competitions. And I had a team last class that used this model in a case competition, finished second place. And they were actually able to answer the questions the case judges were doing that the other students had no idea how to answer, right? And so I'm hoping I'm teaching you transferable skills. But here's the point. The difference between this model and the ones that are used by the sell-siders is just level of detail. So for example, if they do Starbucks in the real world, Morgan Stanley's covering Starbucks, the major difference is you forecast revenue for Starbucks and we forecast growing 5%. You work for Morgan Stanley, what's the price of the average cup of coffee? How many cups of coffee is revenue? That's your coffee revenue. What type of food do they sell? What's the price for food times the number of transactions? Like, they build it up and add it up to get the value of the company. Pharmaceuticals, how much does each drug sell? Right? Price of drug times number of drugs, add up all the drugs, that's the value of the company. That's the revenue of the company. What's the margin per drug? Add it up, that's the profit of the company. So they're just doing a click down level of detail when they forecast, but the process is actually pretty straightforward and very similar. So if nothing else, I hope you learn something by that process and continue to use and apply this in whatever you do, okay? Which then leads to multiples, which is what you're on right now. Multiples are just DCF. As I said, the only difference is we did a DCF, we went 5 years, year by year, and then we did a continuing value. Multiples are just doing a continuing value from day one, all right? It's the same math. It's just a simplified approach. Because we're not going out 5 or more years, it just makes it easy and hard, right? And I think you're seeing that in the numbers. Like the easy part is you only got to do 4 numbers to do the whole value of the firm. The hard part is you got to get 4 realistic numbers that do the whole value of the firm. And for some of your industries, that's easy. For some of the industries, it's not so easy. And that's why I've given today the window to change your companies for Monday. Okay, so if you have a problem, I'm letting some people change. And it's probably less of an issue in this class, but in previous classes, I'll give you an example. So in the airlines, right? United Airlines, forward PE is 4. Today, it's 4. They're trading at 4 times earnings, that's their PE. You can buy the entire company for 4 years worth of profits, right? Air France, which is one of the peers they were looking at, is trading at a PE today of 2. The PE for company in the real world for Air France is 2. I almost have a hard time believing that. Like, these numbers don't make sense. And the poor teams are like, can we please change our companies? Like, we don't know if we can explain this, right? But could you explain this? How does United Airlines have a PE of 4? This is our key value driver spreadsheet, which we've used earlier this semester to kind of understand the concept of multiples and their sum value. Because your multiple is just this. It's the growth spread combination. So the question is, how do you get to a 4? Okay. How do you make this number 4? All right. Well, one way you could do this is if your ROIC was like 20%, and your growth is like negative 40%, or negative 50%, but you get the idea. I can probably get a high enough G, there we go, whatever, to get my multiples down close to 4. All right, so let's just say I solved for that, and they did. They had a giant negative G on a positive spread with about a 15% ROIC. In fact, I think if I make it lower, it might go lower. No, 8, whatever. So my question to you is, let's say that you were able to solve for the PE with these numbers. Why am I going to give you a bad grade on Monday? Because if your answer was that the G of United had to be like negative 50% or higher, what's the problem with that? Yeah.
The company would be out of business in 2 years.
So go to EEO. Say negative 50 is the right answer, which is about the number they had for United. I was proxying it there. To explain that's how they goal seeked it, with the current spread of about a 15% ROIC against whatever the WACC was, at about a 40-50% negative G, they got to the 4 PE, and or ROE. Sorry, cost of equity, ROE. I said, go to this EEO. Say it's negative 40%. Okay. Take revenue, 53 billion, multiply by 0.6. And then go to the next year, multiply by 0.6 again. And go to the next year, multiply by 0.6. Take their profit of 4.2, multiply by 0.6. And then multiply by 0.6 again, 0.6 again, 0.6. That's what you're saying. That's what you're saying is happening to this company. Okay? And so the reason why I'm going to give you a bad grade is that realistically what's going to happen to this airline? No, nobody expects United to go away. Nobody expects United to be a fraction of its former self or even go to bankruptcy. Like, so you can't use that number. So that's one thing I also, and I know you hate writing 500 word papers, right? Matter of fact, you know who hates them more than you do? Me. I don't want to read these damn things. 182 people writing 500 word papers. You think I want to read all those things? No, it sucks, right? That's why I make the TAs do it. That's why, by the way, if you're a TA, you're going to be reading the papers, okay? But the point is, I'm still going to make people do it. And the reason I make you do it is because there's two parts to finance, right? And the first part to finance is solving the equation. You got to get the math right, right? And so when I grade you on Monday, if you don't get the math right, don't expect credit, right? But I'm telling you, the math is algebra. Like 8th graders can get this math right. The math's not that hard, so you got to get it right. But the second part, why'd you use the numbers you used? Your assumptions are more important than your formulas in finance. Remember that. That differentiates you in your career versus any other person going into the workforce because people know how to solve the equations. They don't know why they're solving them. They don't know what it means when they solve them, but they know that to solve them because that was the right answer. And that's what I wanted to work on this semester with you. That's the reason I make you write the papers. That's why I'm so harsh to some degree on my grading. Why'd you use the number you used? What rationale was behind that? What did it tell you when you calculated a number? Because in the real world, a lot of people don't know how to do that. And I find that to be disappointing because that's the problem with math and finance. Like we teach people equations and we teach people how to solve them, and that's not enough. And so we gotta understand assumptions. We gotta understand why. And so back to, you understand like when you put numbers like in the key value drivers with like a big negative G, well, yes, it solves the equation, but that wouldn't make any sense in the context of what you're trying to accomplish. Right? And I'm hoping, and that takes practice, but that's one of the things we've been practicing over time. Okay? So you can't explain it. You can't explain that G and that spread. So what I'm saying is, that's not why United is trading at a PE of 4. It's not why Air France is trading at a PE of 2. Okay? So let me give you an alternative. As a hint, which is what I gave to the teams today. If, look at company A, we have a 0 spread. With 0 growth. No growth, no spread. Okay? What's the PE?
Value divided by profit.
What's the, give me the number. What's the PE? 10. No growth, no spread at this cost of capital is a PE of 10. Okay? What would cause you to have a PE of 4? The growth spread combination has to be less than 10, to get less than 10, it has to be less than 0, right? So I can get there one of two ways. I can get the G to be like negative 50%. That doesn't seem to make sense. Or, option 2, what happens when you grow a negative spread? So, would this be more reasonable? If we had 3% growth and 2% ROIC, let's see, 4% ROIC, that seems like a more reasonable scenario. Now, the problem is the EEO does not show that. The EEO of United, the EEO of Air France does not show this number in the next 2 or 3 years. But this is the price of the company today, and the only way you can explain it long term is if this scenario played out, right? And this is what I'm saying. This is a little more advanced, but this is what I would expect the airline teams to be talking about on Monday. Like, why is United trading at a PE of 4? The only logical reason is the market must think that it has a negative spread long term. That's the only reason, okay? And so why might it be a negative spread? Well, maybe they fear pricing in the airline industry is not going to cover the costs, and they're worried about pricing. Or maybe they fear that the costs for the airlines and the higher fuel costs are just a long-term thing. They're not going to be able to pass it on to us, and they're just not going to make as much margin every ticket. Or maybe they think that all the planes they have to buy. There's a reason why these airlines are struggling with growth with the Boeing planes, because when I flew Delta from Atlanta last week, I was on a plane that's almost as old as I am. 757. That 757 is like 40 years old. So these airlines have a lot of really old planes, and they have to replace them with new planes. And then you have other countries, like China, which are all new planes. And then you got the two, it's Emirates and what's the other one out there? Qatar, and Idiot, or whatever they're called. But the point is, they're buying all new planes. So it's not that it's not going to be good for the consumers to have all new planes, which are more fuel efficient. It's just these planes are really expensive. So the return on the investment might be low because they have to spend so much to buy the planes, they're not making enough margin to do it. And maybe that's why the market's concerned about the lower PE. I don't know what the final answer is, but this is what I would expect to hear on Monday. It doesn't have to be like 15 minutes on that, but you gotta say something if you give me a low spread, not just the answer is 4% ROIC. Right? That's why they're trading at a discount. Okay, but why are they trading at 4% ROIC? You got 7 or 8 people on your team. You should have one of them be able to have some reason why you're using the numbers you're using. Not just for the presentation on Monday, but just in general. That's what makes you good. That's what makes me good. That's why I do stuff outside the class. Because unlike most finance people who know how to crunch numbers and that's it, I know how to provide context. I know how to ask questions. I know how to get people to link the decisions to the answers. I'm not saying I'm perfect at that, but I'm good enough that other people won't do it, that's a benefit. And I see that all the time. Like those are the people who do better in organizations. Those are the people that they want to have be their leader. They don't want the pluggers and chuggers. And that will differentiate you when you get your job, regardless of what that job is. Doesn't have to even be in finance or accounting. If you can give context around it and understand why you do things and explain what you do, you're a lot better off than any other undergrad that's out there. And that's something I hope that you take from this class. That's what was hard on you, right? Because you're not taught this in any other class. You're taught in every other class. I mean, I barely studied when I went to Wharton. I was smart enough to know how to solve the problems of the exams, and I was never pushed to think, right? And to be honest with you, in hindsight, the older you go back and you look, I was like, that was a loss. Like, I really wish I thought was taught critical thinking. I wasn't taught critical thinking. I was taught how to solve formulas. I was really good at solving formulas. Okay, I had a 790 on my math SAT. I was smart. But that didn't make me a smart finance person, right? That came from getting on the real world and then people challenging you and the questions you ask. They say, "Can you explain the numbers you solved?" And most people are just like, "I don't know." Right? And you don't want to be in that situation. There's very few people that get away with making shit up. Donald Trump is one. He's it. Right? Matter of fact, did you see the ABC interview where he said crime fell 72% in Venezuela, and all those people that they released their prisons came into the U.S., and that's why we have so much crime in our country. And the guy from Detroit News said, "Where'd you get that figure?" He's like, I don't know. I heard it from somewhere. So make shit up. But that's the point. Like, you can't do that. There's very few people that get away with that. So in the real world, you got to use data. You got to explain what you use. That's why I force you to do these things, and you got to be able to have context around it. Remember that on Monday. I really hope you get a 10 out of 10 in your group presentations. I don't like grading you down, but I'm not going to just pass you to pass you. So there's going to be 2 things that lead to less than 10 out of 10. Number 1, there's a technical side to what you do. Okay? If you don't get the math right, and you don't show me where your data coming from, you're going to get marked down. Okay? So get that right. And then number 2, give me context. Use numbers and give me context. So don't just say, this company's at a premium or discount. Tell me why. All right? And give me a sentence or 2. Right? Why does this company have a higher spread than the other? Why does this company have a higher growth than the other? Is it their competitive advantage? Is it what is it? So add that in. We'll learn a lot about the tech industry, and you guys will get good grades. That's what I'd like to see on Monday in your presentations. Right? If you need to change, I asked earlier, hoping nobody has to change. I'm giving you the opportunity to pick 2 peers. I'm pretty vague about this because I'm giving you the idea to take more easy to understand peers. Like, you're not the airlines where every airline has like this really weird spread situation I just showed you, and it's just a much tougher presentation, right? You don't have that here. So, but I hope we still learn about the tech industry and how we're doing in a little bit of context. Right? If you have any questions you want to ask about your presentation, I'm around. If not, TAs have office hours next 2 days. Where's the sign-in sheet? Make sure you sign that before you leave. And otherwise, look forward to hearing your presentations on Monday. Good luck.